Hello everyone, this is Sebastian McMahon from IA Financial Group, and I'm back with the weekly review for the week ending December 6th, 2024. So we're nearing the end of the year. We're starting to work on our outlooks for 2025 macro markets. Of course, we've been building that for a while, but here starting to share maybe some shades of the material that you will be hearing about more as we get towards the end of the year and in early 2025. We're working on the next monthly, the one that will come out in early January will be an extended outlook for the year, but still we'll be touching a few elements here, mostly on Europe. So this week, the title of the presentation is Politics, French style. Lots of things happened in France this week. A tough week for Macron, a tough week for PM Michel Barnier, and also showing us how weak of a handoff Europe is giving to 2025 here. So maybe before we get into the details, let's look at the returns this week in the markets. Even though we've had this turmoil, even though there's geopolitical risks that remain, stocks continue to push higher. Usually the seasonality tends to be the strongest in November and December, and actually the second half of December is the strongest seasonal period of the year, mostly because of buybacks that are pretty strong on the US stock market, but also there's this Santa Claus rally that tends to carry momentum and to carry sentiment towards the end of the year. So even though we had some turmoil in Europe, actually the labor market, the stock market rather, in Europe is pretty strong, and we had ended the week with close to 2% on MSCI EFI. So looking at the year-to-date figures, again, we're getting close to the end of the year. Unless we have an accident until then, we should end up comfortably positive on both bonds and equities. 30% in the US, 26% in Canada, and between 13 and 15% for EFI and emerging markets. Oil down on the year, Canadian dollar depreciated a fair bit, 5.6% lower in the year. Of course, that helps returns for Canadian investors that are invested in the US. There's that. We have a pretty strong view that the Canadian dollar should be stronger in 2025. More on that maybe in the coming weeks. But also euro down, price of gold up 28%. So focusing now on France. So this week there was a vote of non-confidence in France. So Michel Barnier, the PM, had to present his first budget. There are some constitutional provisions in France where when you feel that you don't really have the support, you're not going to have the votes, you can use Article 49.3, which is a way to just force a bill through, but that opens the government to a vote of non-confidence for a window of 48 hours. Marine Le Pen and also the left coalition jumped into that window. No confidence vote was successful, and now the government has to be dissolved. Now Mr. Macron has to name a new PM over the next few days, although there is nothing in the constitution that sets a timeline for how quickly the president must name a new PM. But Mr. Macron made his intentions clear that he wants to name someone by the end of this week. So let's see how long we stay in limbo over there. But the implications are pretty important here because the government now stays in place. You cannot go into an election again. They cannot go into an election until next July because you need to wait at least a year between two elections, and they went to election this summer. So they're stuck with the pieces that they have here on the chessboard, and now the government is more there in a caretaker role. So there are some exceptional laws that they can use that have never been used before to collect taxes, to direct some spending. But of course, there are some risks here. If you're a French bond holder, that there could be some more hiccups here along the way. So the market reaction was actually pretty muted, we feel, given the circumstances. So if we go to the next slide here, on the left you have the spreads between the 10-year rates in France and Germany. So the spreads are at about 80 basis points now. That's about in line with what we've seen in 2017 when there was the French election and Mr. Macron took power. But we're still far from the worst part of the Eurozone crisis in 2011 and 2012. So what should have been the appropriate reaction, we have no clue, but we still feel that given how important this maybe setting the tone here for Europe in 2025, because there are many countries that are dealing with the difficult fiscal situations, many countries where populism is on the rise. There are some opportunities, some political opportunities for any politician here that is feeling the weakness of the government trying to play politics to go grab more power there. So we feel that maybe this could be significant. So we don't know if we can say that the worst is behind us and now that it's a buying opportunity. So we'll stay very careful with our view here on French bonds, and also the euro chart on the right. There was some pullback from the strength of the USD, of course, with Donald Trump coming, and everyone knows that Europe would be targeted with tariffs on the auto sector more precisely. So strength of the USD is evident in the chart on the right. The turmoil here in France caused the volatility around 1.05, but now the euro is up to 1.06. So we see cautious optimism. We're just not sure that the worst is over. So we'll be careful with these. But now if we start to look at 2025 for Europe, the question that we're asking, the right question we think is there an opportunity or is this more of a value trap? I've discussed the trade risks. There is a renewed front with the US on trade. The automotive sector is at risk. There's a broader trade war potential also as well. Now the US is investigating into European digital taxes and industrial subsidies. So this could escalate border and tariff measures. Now the fiscal challenges, of course, in Europe there is the fiscal landscape is under strain. The war in Ukraine is stretching the budget of pretty much across the continent, with many nations that are contributing significantly to Kyiv. The commitments of about 50 to 100 billion euros over the next few years in additional financial and military support. So there's pressure there on a backdrop of aging population, low productivity growth, efforts to boost the European defense industry, the need to create new financing solutions, just like joint EU bonds. So you have this backdrop in Europe. So seeing this political turmoil right now, we feel that maybe France could be a bit of a bellwether here for things to come. But there's also a contrarian view. Europe might have some long-term potential. No, markets seem to be undervalued over there. Structural reforms could be coming or forced with everything that we're seeing now on the political turmoil. And also the green transition is very important over there. There's a 1 trillion euro investment commitment for the next decade, which is kind of a cornerstone here of Europe's growth strategy. So there's reasons to love Europe. There's many reasons to be careful about Europe. So given this end to 2025, and also I didn't mention, but the PMIs in Germany are weak. Industrial production in Germany is weak as well. So I would say that is there an opportunity yet, or is it a value trap? Should we wait? But that's going to be a very important investment theme in 2025. So just wanted to wrap up our views on the European topic right now. It's going to be a very important topic in 2025 for investors. Now, looking at the jobs report that we had this morning, we had Canada and the US. So first in the US, labor market remains solid. We created 327 jobs in the US in November. There are two reports in the US. This is the non-farm report, what they call the establishment survey. There's also the household survey, which is used for calculating the unemployment rate. This one tends to be more volatile, and it showed a loss of jobs, a loss in the size of the labor force, and more unemployment, so a higher unemployment rate. Markets this morning are focusing, maybe taking the best parts of both reports. So creating more jobs, that's good for the economy. Stock market is up, but also unemployment rate is a little bit higher, meaning that the Fed will cut on December 18 and maybe cut more than expected over the last few weeks in early 2025. So this is the chart that you have on the right. Markets pretty much 90% odds of a cut on December 18. We think it's a lock. After that, if we were to advise the Fed, we would advise them to cut in December, say that you're going to be data dependent. There's many things that are going to happen in early 2025 with the Trump inauguration on January 20th, and the next decision of the Fed will be on January 29th. So you keep the door open, see what's announced, what comes up, what the data looks like, and maybe slow down in early 2025. And anyway, Mr. Powell was very clear recently saying that the data is better and that affords them time to take a more measured approach here. So less cuts in early 2025, but now based on the data, the market is looking for a better understanding or a better grasp here of what's to come. So market is still searching, so that could bring some volatility over the next few months. Canada, now we have a beat on the headline, but the unemployment rate keeps rising. So 51,000 jobs added, solid number, but the participation rate was higher, which is actually a very good sign for a macroeconomist like myself, but that does push the unemployment rate higher. So markets are reacting a little bit to that. They see this as being negative. Wage growth also stalled from close to 5% to 4%, still solid, but that's a pretty significant step down. And on the right, you see the unemployment rate rising in Canada and also in most provinces. Now we're at 6.8%, excluding COVID. That's the highest since 2017. So again, arguments for the Bank of Canada to cut next week for sure. We still think that they should cut by 50 basis points next week on December 11th. After that, in January, let's see how the data comes up, but we do not exclude the possibility that the bank cuts again by 50 basis points. The rush to neutral continues. The Canadian economy showing some interesting signs here, but overall GDP growth is slow. The Bank of Canada has been worried. There's no reason here for them to change their mind that we need to go to neutral as quick as possible. So let's go there quickly. That would be our recommendation. But market consensus is thinking 50 basis points next week. So it would be a surprise if they cut by only 25 basis points. So what we'll be watching next week, consumer confidence in Canada, but again, the Bank of Canada rate cut consensus is at 50. So again, that would be a surprise if it was only 25. In the US, we'll have the NFIB small business optimism data and CPI inflation. So another very important data point for the Fed. We don't think that anything will come to change their view for December 18, but maybe for things to come. Markets were expecting a tick up on total inflation to 0.3% month over month. 2.7% year over year from 2.6 last month. Core should be pretty much stable at 0.3 month over month and 3.3% year over year. So that wraps it up for the week. Always a pleasure to serve you. If you appreciate the content, please share. And of course, come back again next week.